All right, ladies and gentlemen, this is episode I don't know what, and it's brought to you by the enormous major profits from calendar spreads in the last few weeks. That is the sponsor of this video. Now, I'm going to talk about three things. One, trade update. I'm going to show you how the latest calendar trades are going. Two, economic confusion. There's been a preponderance of conflicting data economically, and I want to talk about that a little bit. And finally, lastly, I'm going to introduce a new strat here and show you how to set it up in Robinhood, because that is the broker of choice. Now, without further ado, let me show you how the trades are going. First of all, it's the two latest calendar spreads, the 150 long put calendar spread, and then the 148 strike price one that expired this Friday. Now, in a couple videos ago, in the last video, I mentioned that these will be exited by today. However, it's just so little action. It turns out what I've learned, I've learned something. What I've learned is that in options, I think the fatness of the premium leading up to major economic announcements, it's more than factored in. So I think it's even more factored in than stocks. I did not think that it was that influenced. But I guess the theta decay didn't really matter between Monday, when I put on the original, and Thursday, which is today, Thursday night. Virtually no decay happened. So let me show you the trade right here. So here it is. Look, the 150 strike price only up 9%. Now, if you had a lot of money into it, 9% would sound like pretty good, right? Oh, that's today. Sorry about that. Let me do the 1 week. 16.19% or $17. Now, if you had a lot of money bet on the $17 in 4 days would be, or 16.19% in 4 days would be a tremendous amount of money. But the risk you're taking with these calendar spreads is a lot bigger. So that's not a very good payout for this money. So I've decided, against better judgment, to keep these calendars through tomorrow. Let's take a look at the other calendar spread, which is the 148 I layered on Tuesday or something, Monday, Tuesday. So it's only up 7.34%. This is the movement. And that one as well, it did not really do anything in the last 4 days. Both, Apple Premium Options is awaiting the data that's going to come tomorrow. I guess we're going to have some economic data, CPIs or whatever it is. And that's going to matter quite a bit. So I'm expecting like 100% swings on these options, up or down, in 1 day. I'm going to be slowly watching it. I don't know if you can watch anything slowly, but I'm going to definitely be focused. But I'm going to check in throughout the day, every hour or two, to see how these plays are going. And I will try to exit at an appropriate time. Now, timing is always difficult. If I can't exit, I'll just let it idle close at the end of the day. We'll see what happens. But for the most part, I'm just disappointed how little action these trades got in the last 4 days. 3 days, I guess. Monday was off, right? So, moving on. The next topic on the chopping block is economic confusion. Now, what is this economic confusion that I'm referring to? Well, there's been a lot of data that's been coming out, and I like to watch the data because I'm trying to predict how volatile the market's going to be next week and the following week, etc. And there's been a lot of weird stuff happening. So, for example, consumer data from the previous quarter has been revised down. GDP has been revised down. All kinds of weird stuff's happening. And some people are expecting an inflationary impulse, but then liquid natural gas is falling through the floor, except like yesterday or something when it shot up. I forget which way which day exactly, but it's been really volatile, searching for like price levels, and I'm not even sure if we're looking for an inflationary pulse, a deflationary pulse. Like, is the economic data slowing down? Are we going to a depression? What are we going into? Like, look at these numbers here. Lithium's up today quite a bit. You got like Euronav. So these are all like, tankers and natural gas related companies. Like Chemical was, I'm sorry. No, these are banks. Where's Chemical? Chemical, where are you? Oh, down at the bottom. Never mind, that's flat. But all these like liquid natural gas and related like stocks have been just skyrocketing, and I just can't figure out, like, yes, these revisions are coming down for economic activity and GDP and all that stuff, especially inflation adjusted, right? And employment data. And then also, I'm totally confused. So I'm thinking we have a very volatile week ahead, because the messaging is really not clear. And what the markets really hate is they hate uncertainty. So they don't want to be confused about what's going to happen the next week or the next month or next year. So with uncertainty, people are going to be going to cash. So prices of things are going to drop. They're going to start hedging. So there's going to be a lot of activity that's going to be happening. Plus the numbers are going to come out tomorrow. So I'm expecting like a flood of activity. No pun intended. It says flood on my weather app here. 40 degrees Fahrenheit flood warning. Really strange. Really strange behavior by the weather and by the markets. So we'll see what kind of storm the S&P or the commodities sector brings in tomorrow. Finally, so anyways, the conclusion of all this is volatility up. Finally, what strategy am I going to use next week? Well, I already got burnt out by using an appropriate strategy this week for the incoming like Friday, and I didn't gain much for that. But I'm going to try to do the same next week. I'm going to do a volatile favoring strategy. Now, what are those? The simplest ones to do is a strangle or a straddle. What is a strangle or a straddle? Well, that's a very good question, my friends. Let me show you. So a strangle or straddle is basically when you go out, pick your date, let's say February 24th. No, let's go March 3rd. And you choose a strike price, let's say somewhere that's close to at the money. So 149 at the moment. And then you buy a call, and you also buy a put. You see how this works? So basically, you lose a ton of money if the price stays flat. And then you start gaining if the price goes below 144 or above 153. You see how that goes? There's another way to do a similar effect, which is the inverse calendar, which is actually what I might try to do instead, because you'll see kind of softens the edges a little bit, makes this trade more palatable. So if you want to do a reverse calendar, what you want to do is you pick March 3rd, and then instead of selling the nearby call, you buy that. Okay, let's say we're working with calls. You buy that call and you sell the next week's. And you see what happens here? It's a soft-edged strangle. All right? Even Robinhood doesn't recognize it, because they'll be like, Robinhood's like, what are you doing? This is an unrecognizable trade. It doesn't make much sense. Why would you do an inverse calendar spread? The whole point of calendar spreads is just to collect premium. What are you doing? And so it doesn't even give me a name up top. Look, it just says custom. But basically, if you look at the chart here, it starts paying out under 145, which is better than 144. on the Strangle, and over 152. Do you see this? It's going to pay out minimal funds up until it goes a little bit further, but it turns green sooner. And it's a lower cost option, right? It's only going to, it's going to create me 102, and then it's going to probably come down in value over the course of the week if the price stays flat. But it might increase. It might, I might get all that credit if the price of Apple just basically completely either implodes or explodes. So I'm going to get most of that credit if that happens. It's strange. Not everyone's going to do that inverse calendar. It doesn't make much sense because I've been so successful in the calendars so far. If these two calendars are profitable this week that I have on right now, I will have done 6 profitable calendar spreads in a row. That's very good. Now, volatility doesn't necessarily mean that we're going to be, by the way, we're in the next trade strat for next week section of the video here. Trade strat for next week. Just because something is volatile doesn't mean it's going to end up really high or really down below. Like, you could still have a lot of volatility and end up flat. Like, what if you're trading down $10 and then up $10 in the same day? That's a lot of volatility. But you could end flat. So it doesn't necessarily mean the trade's going to be profitable. But all things considering, that may be a good thing to try here if we're expecting a big move. There are many different ways to actually go long vol or profit from the market's volatility. Some different ways that you could do it is you could try to play the VIX index or the volatility index. Let's try to find that. So you could go, let's just type VIX here and let's see what happens. How about the VXX iPath Series B S&P 500 VIX short-term futures ETN? There's a lot to unpack here. Yeah, Robinhood is warning us that it's a volatility product. Yes, we know. Thank you, Robinhood, for that. Appreciate it. It's got a little yellow warning label. I like that. So you could try to play this, and you could figure out, okay, I can buy this and expect volatility to go up. Like, you can see that over time you're going to lose, right? Because it's kind of based on premium. And so over time, as volatility gets crushed, see in March 2020, for example, if you hold this long term, it was at 200 and now it's at like 11, right? So you don't want to hold this long term for sure. So it has a lot of beta decay on it. And so what you want to do is do short term. And in fact, it's been going up in the past month slightly for some reason, even though it feels like things are coming down. But I think it's a good bet. Like today, obviously you got crushed because nothing happened. But tomorrow will probably spike, and it might be a good trade for like 1 week. So this could be a vehicle that you could hold for like a week at max. I wouldn't suggest holding for more than a week because there's a lot of time decay mechanics in this fund that you don't want to get stuck with. So it's not really a great idea. Outside of doing straddles and strangle strategies or reverse calendar, this might be a good bet to bet positively on volatility. So those are some other ideas. You could also do other stuff. I mean, you could just buy a stock and sell at the money calls on it, like cover a call right away. You could buy a stock and buy a put at the same time on that same stock at the money or something, because that way if it goes up by a lot, you make a lot of money, you sell the stock and you cover your premium expense by the put, And then if it goes down a lot, you get to keep your stock, but you also don't suffer a lot of losses because the put prints. So there are many different ways that you could play this. I personally, I'm thinking of doing the reverse calendar. I don't know why I'm so obsessed with the calendars, but maybe I'll just do a strangle, or a straddle. What is the difference? Well, let's go back to the options wheel. Since you asked, I want to be nice and explain the difference. Okay, it's a good question. So we're going to go in here, pick a date, March 3rd. Let's go with the 149 strike price contract again. So buy a call, and then buy a put at 149. So that is a straddle. Okay. That is a straddle. It looks like this, like a point in the middle. It says long straddle because it's above the strike price. It would be short if it's below. But it's pretty much at the money. So it's not neither long nor short, really. So the point payout looks like this. Maximum loss at 149. And then it pays out if it goes really far up or really far down, right? Now, what if we did this? Oh. Well, it's another way to get the same effect, basically. It says custom here, but it's basically flattening out this bottom part, you see? Flattening out the bottom part. I thought that was a straddle, and then a strangle was when it's a singular point. Am I mistaken something here? Let's try to build a reverse iron condor and see what Robinhood thinks about this. But basically, this strategy factors in a window between 149 and 152.5 where you kind of cap out your loss. It doesn't point. It's more like a window here, right? And it's usually like a lot cheaper to put on. And the stock has to move quite a bit more for it to pay, but then you don't actually pay up as much up front. And so it's much more like cost efficient, but lower chance of payout type of play. Let's try to set up. Let's go to let's see, buy call. Let's get rid of this. Let's go to March 10th and let's see if we can set up a reverse iron condor here to where we buy 152, we sell at 155, let's say, and then we buy at 150. I'm sorry, we go to puts and we buy at 150 and we sell at 149. Let's see what it says. Custom, but it's similar effect. I mean, you can see that you can see it's a similar effect, right? I don't know why they changed all that, honestly, but whatever. Anyways, the wings look a little bit weird, but basically it's the same effect. So you lose if the price goes somewhere near where the price is now, and then you win if the price goes really high or really low, and it just kind of caps out. So there are many different ways to set this up. I have no idea why they changed the names of these things. Am I just going mental? Like, let's see, definition of straddle options. I can type strategy. Okay, so buy one call at boom and one put at 320. That's exactly what I did, didn't I? I bought a put and a call at a different strike price. Oh, at the same strike price. That's a straddle. Okay, so strangle. Sorry. Let's see. Of strangle options strategy. a strangle option strategy in which the investor holds a position in both a call and a put option with different strike price, yes, with the same expiration date and underlying asset. That's exactly what I did. Why isn't it giving me the strangle? Okay. Let's try to build it again. Let's go to a random date here, March 17th, let's say. So I'm buying a call and I'm buying a put with a different strike price. Oh, there we go. It worked. Maybe I accidentally built it differently the first time around. So I'm not going crazy. There's the strangle. So you see how it gets flattened out at the bottom, and then you win if it goes on one of the wings, right? Below 140 or above 158 in this case. Okay, because and you can put this really far apart. And what's going to happen is it's going to decrease the cost of the structure of the strategy. So if I go really low, look what happens, right? My maximum loss is a lot smaller, but the stock would have to move quite a bit, right? So let's say I go all the way up here, and now look how cheap it's going to be. It's only going to be $37 cost, but if it goes below 124, which it won't, right? Or above 165, which it won't, yeah? We win in either direction. We only lose our $37 if it stays the same. So those are the two strategies to take advantage of volatility. I apologize for the long Google search here, but I thought I was going crazy for a moment. Maybe I set up, if I watch back this video, I'll probably set up the first time a little wrong. But if you think of any other ways to take advantage of high volatility, let me know. I do think the volatility is going to be high to close out my thoughts, because this is already running at 22 minutes. It's ridiculous. Let me know in the comments if you have your favorite way to take advantage of volatility, and I didn't talk about it. All right. With that said, I'm gonna end it right here. I will update everybody on the trades if I manage to close them in the green or in red tomorrow, probably via a post in the community tab and YouTube, or I will let you know if I put on a trade for next week. So look out for that. That's it for now. Peace out.